Hi, everyone, for your second ESG session of the afternoon. We are the ESG session Investor Perspectives. I'm Elizabeth SEEP. I'm with MSCI. I run our ESG fixed income product team. And I'm here with a great group of panelists to really build on what you heard in the last session and really give you a lot of takeaways to hopefully go into drinks with tonight. We'll go a little fast. We're limited on time, and we have a lot of interesting content. So they've allowed me to introduce them for them, so I will go down the line. We have Rob McDonough with Angel Oak, Alexander Bacharov with Bank of America, DESIREE FIXLER with ZAIS Group, Alessandro Pagani with LOONIS Sales. Oop, I missed one. Sorry, Neil. Neil HOHMANN with Brown Brothers Harriman, and on the end, Pia McCusker with State Street Global Advisors. So today we really want to walk away with a few goals for you, give you a sense of where these firms are on their journey of integrating ESG within their firms, as well as a lot of concrete examples per asset class of what each of them are doing, because they're really on the forefront of ESG at their firms. We also want to expand our horizons and give you a bit of a global perspective on structured finance and ESG globally, and then give you a whole bunch of quick takeaways as well. I work on ESG 100% of my day, every day, so from kind of a big level perspective, I can really say that ESG and structured finance is really, the last frontier, on top of maybe, distressed debt or very, very private loans. Outside of that, because of the principles for responsible investing, I work with all the largest asset owners, asset managers, et cetera, and, they have fully integrated ESG into equity, fully into bonds, growing in loans, trying to figure out municipal bonds because it's such a big, complex space. And I'm hearing a lot of feedback about product and data needs for structured finance now. So it really is kind of the last piece of the puzzle. So with that said, I wanted to ask the audience just a quick question so my panelists get a sense of where you all are. So could I get a raise of hands if you or your firm are fully integrating ESG into your investment process? Okay, and somewhat integrating it, ad hoc. Okay. Anyone still hates the fact that there's no consistency in terminology and definitions and things like that? We need to start a little sooner. Okay, so good. Hope that gives a perspective. And so the first question for the audience is, almost all firms in the global investment community have integrated ESG into their investment process. The industry has moved well beyond ESG exclusions and screens. So can you please pinpoint where your firm is on the journey? Go down the line, Rob.
Sure, so Angel Oak is a vertically integrated mortgage and credit risk firm, and so we control everything in our organization from mortgage origination to funding through our investors' capital to, actually we have our own securitization platform. We securitize we securitize residential mortgages into asset-backed securities. So we are issuers and investors. But we have had a very uphill climb from the very beginning, the inception of the firm, in terms of communicating our ESG alignment, because we have had inherently to be ESG integrated. We are originators and securitizers of non-QM mortgages, and to many people, non-QM means subprime. So from the very beginning, our business model was challenged by external stakeholders who said, how do we know that you're not just trying to cram down subprime mortgages, and how is this in any way socially responsible? So we had to craft our message from the very beginning of the firm. It was integral to our business model. What really crystallized our ESG integration efforts were really becoming signatories to the UN's PRI in 2017. So we've had about 4 years of full-time effort in terms of integration across our entire firm. And the way I would characterize it, and it's because of reverse inquiry from investors, is that our integration is across the entire firm. It's not just in our funds and in our strategies, which we do have embedded ESG mandates, but it's across our entire firm. So we have a global responsible investment policy. We have a director of ESG, that's me. We have staff working full-time on ESG across all of our desks and portfolios. We have other outreach in terms of our Community Relations Committee. We have a Diversity and Inclusion Committee. So we're trying to cover really all the bases of environmental responsibility, social responsibility, and also strong governance. We do have one fund that is fully ESG integrated. It's a corporate credit strategy and community bank subdebt, and that's been recognized by Morningstar as an ESG engagement fund. So we've checked all the boxes around that. More importantly, though, we have data to stand behind why our strategies are ESG integrated. Our next steps really are to try to get our mortgage supply chain fully integrated so that our whole loans and our securitizations, as well as our investments in RMBS 2.0, have the data to support the fact that we believe that these are inherently ESG-aligned investments. That's our next challenge.
Being in research, I don't think I'm in a position to discuss the commitment of the bank. I'm sure it's unwaverable. We're number 5 underwriter, we're in the top 5 underwriters of green bonds. We have been very actively involved in developing the green bond principles. And from research perspective, it's a topic which is widely covered both in equity and fixed income, in our thematic research, in our individual companies and sectors, and I personally cover it in structured finance.
Hi there. So at ZAIS, we approach ESG in 2 parts, and it's pretty similar to Angel Oak. So for the first part, it's about, we have a firm-wide ESG integration policy. This is about enhancing our risk management framework. This is about optimizing financial performance. So in every single investment, we focus on financial materiality derived from ESG risk factors. The second part of our ESG strategy is actually advisory and product development, where we focus on creating products that have positive environmental and social impact. And this framework is aligned with the UN 17 Sustainable Development Goals.
Thanks. At Brown Brothers Harriman, I mean, we also have a firm-wide policy on ESG, but we're bottom-up managers. You know, we look at, we do deep fundamental research on credit, and so we typically have looked at 200 to 300 different attributes for individual fixed income credits that we look at. And over the last few years, we focused on several dozen that are relevant or material for ESG reasons. And we developed a framework specifically on those variables. But obviously, that's not enough. We also need to identify those variables that aren't part of the typical credit work, but that are relevant for ESG purposes. We do that in a couple of different ways. You know, one of those is to go out and engage with issuers, so ask them these questions about the information that you don't have. Also, our analysts that do all the research on those credit attributes and on our that go into that framework also do independent research on these variables. Now, if anybody at this conference tells you they have a thorough framework for looking at securitizations in an ESG framework, take that with a big grain of salt, because it's really early days. We put out our first publication on this, and we'll talk about this a little bit later, but I think there's a lot of thought that still needs to go into how specifically to look at securitizations from an ESG standpoint as opposed to corporate bonds and equities.
Thank you. So at Loomis Sales, obviously, we have ESG policy. We have an ESG director that tries to lead the effort of integrating ESG consideration across the overall investment process, and we're signatories of the UN PRI. I think one key decision that was made at the highest level was not to focus on ESG as a product development, as a way of raising funds, but acknowledging that ESG principles are the foundation of all that we should do, because it benefits all investors. And one of the pillars that we've been focusing on for the last 2 years is trying to change the outcome and the behavior of the companies with whom we invest. So the principle of engagement is one of the kind of the core activities that we do from a day-to-day basis, which is very impactful when we think that we have 54 corporate analysts on one side. And it was very actually interesting to start asking our ABS issuers, what do you do on ESG? And the blank stares that we would normally get 2 years ago. And from the blank stares 2 years ago to see rooms full of people, you can see how just asking the question is important. And to your point, what we're struggling now on the structured finance is precisely that. What is ESG? The lack of definition, the lack of data. So I'm more concerned about what we don't know about that than just putting on a label and say we are ESG when we do not know what it means yet.
Hi. So State Street Global Advisors is a leader in ESG investing. We've been doing it for over 30 years. The ESG investing spectrum goes from obviously exclusionary screening to best in class to thematic solutions, so low carbon, climate investing, and data integration. Data integration is actually a journey that I've been on for the past 2 years. As an investor, you obviously want this information, good information. So what we at State Street Global Advisors, we designed a new ESG scoring system. It's called R Factor. I'm from Boston, so I have to say the R properly. R stands for responsibility factor. It's designed to have a more sustainable companies and capital markets. And we built it not just as a resource for SSGA, but also to investors, making it available for everyone. There's 2 components to the score. There's the ESG score and corporate governance. Reason why we broke it apart is because the underlying data is vastly different. ESG score is industry specific, market agnostic. Climate change will impact everyone, but it can impact an asset manager versus a consumer company differently. Corporate governance score is market specific, industry agnostic. You always want to have good governance. Good governance in Japan is vastly different from good governance in the US. And so with what we did is we took raw data of underlying vendors and we mapped it to SASB, Sustainability Accounting Standards Board. And the idea is to have a market standards for what is financially material for each of these companies. We created the scores from 0 to 100, and 100 is an outperformer and 0 is a laggard. And the idea is to provide this information to our portfolio companies. So as a stewardship effort, you are providing it to the company. It's kind of like a positive feedback loop whereby you can tell them what their score is and then let them know where they're underperforming and how they can improve it based on the SASB materiality framework. And second, it's for solutions. The information is available across all of our investments team on the firm, and as a result, we are creating the next generation of ESG solutions. So for instance, we partnered with SASB and Bloomberg to create indices that are powered by R Factor. And obviously the third is client reporting. Obviously clients will want to see sort of like the impact from front to back end in terms of what are the things that you are doing to improve your score historically.
Thank you. So I hope that gives you guys a good perspective of where the clients are, and I think, this is representative of what I typically see on a daily basis as well. One thing that several of you brought up is, how nuanced ESG really is when we get to structured products. A firm like mine will give an ESG rating of an issuer. We look at the main ESG risks of that company and how management is mitigating those risks and create a score. But it all goes back to the corporate, right? You can tag a bond to it, a loan to it, an equity issuance ticker to it. But really when we get into ESG, we have to look at all of the different products within structured products differently, whether it's MBS, CLOs, et cetera. So I would like for a few people on the panel now to really, dig into the practical examples of a specific a product within structured products and describe, how are you doing this ESG analysis? Are you looking almost exclusively from a risk mitigation standpoint, or are you really focusing more on impact? I think this space is really interesting, almost like the municipal bond space, where it can be inherently impactful. A municipal bond is inherently impactful, so it creates a lot of product ideas around that, as well as lending to consumers across our society is inherently impactful. So I think that is a difference about this category versus maybe just a corporate bond issuer. And also, if you can pinpoint anything that's more or less financially relevant for ES or G. So maybe I'll kick it off with Neil. Can you touch a little bit on the heat map that you've developed and some specific examples with MBS and ABS?
Sure, I mentioned that publication, and it wasn't really logistically possible for us to show you the heat map. It's kind of interesting to see. But if you're interested, you can Google BBH and ESG or me and ESG, and you can get the paper. But we developed a framework specifically to look at securitizations from an ESG framework because it makes up about 40% of our broader portfolio, so it was important for us to be able to have a thorough, consistent approach. And it's a three-pillar approach because it's very interesting. We feel that it's not really feasible just to apply a typical corporate approach to an asset-backed security. Obviously, what characterizes asset-backed securities or securitizations generally is their legal insulation, isolation through a trust structure from the broader corporate risk. So it's important to recognize that, recognizing still that there's some corporate exposure. So we developed a three-pillar approach. One is analyze the strength of that corporate exposure. The second is you do need to look at the social and environmental risk in the underlying loans and leases. So that's a little different than looking at a corporate bond. And then the third, obviously, there's potential governance exposure in the trust structure itself. So that's the approach that we took. And we used this approach to look at 30 different subsectors of the structured market. Among them, a number of different ABS subsectors. And interestingly, what we found is that apart from some ABS deals that were associated with internal combustion engines, like autos, obviously, or fleet lease. And then, obviously, there's some parts of the consumer lending market where there's higher rates, predatory lending concerns. Generally, there's a lot of green when it comes to ABS, and investors aren't all that familiar with ABS. So it's interesting to hear that ABS generally has a rather benign profile. There is one big exception, which is whole business securitizations, because when we looked at whole business securitizations, they're largely a pass-through of the corporate risk. So they tend to have the same types of exposures to corporate risk as the corporate bonds do, but just without the mitigants. Looking at agency MBS, or looking at MBS generally, not surprisingly, there's a lot of red in legacy RMBS like subprime. These are loans where borrowers have difficulty making payments. Not surprisingly, there's major social concerns there. But interestingly, when you look at agency MBS, these are guaranteed by a single company, by the agencies. And they tend to be thought of as government debt. But there is uncertainty about the future of the agencies. There's a huge impact in the direction the agencies go in terms of social policy. So even with agency MBS, which you might think would be relatively benign, we found a moderate amount of potential social risk with agency MBS. CMBS is pretty benign, maybe with the exception of a few sectors, dare I say, casinos. And so I think generally a benign profile, though, but you have to apply, I think, a consistent framework to see where those risks are.
Thank you. Let's go to Rob. Rob, can you pinpoint, how you're looking at RMBS and give us an example?
Sure. So Neil talks about some good examples around the agency space and also some of the legacy assets that are out there. And so we're really focused on private label RMBS 2.0, and there are a lot of issues there. And we get a lot of investor reverse inquiry with regard to some concerns around them, not really having to do primarily with credit. So as an example, 4 years ago or so, when there was a pretty rough hurricane season, we were getting a lot of requests from investors, hey, how is my pool and your security exposed to that particular weather risk? And so we had to be pretty nimble in terms of getting the data around that. And luckily, we have the ability and the capacity to do that because we have zip code level data where we can really drill down and find out based on some declared emergency zone or just some specified geography as far as what kind of exposure we had and what meaning that might have with regard to delinquencies in the, in the next 30, 60, 90 days or, how impactful any kind of FEMA intervention might be. And so we were able to respond to that pretty quickly. So it was data driven. And to expand that, really, there's kind of two ways that we think about RMBS risk, and that is, RMBS with regard to ESG. And one is risk focused. So hurricanes are a good example of that. Wildfires have been kind of front page news for a while. There is data out there that actually specifies what zones down to the zip code level are especially exposed to wildfires and just general flooding risk outside of hurricanes as well. So that data is actually available and out there. and that's a data integration project that we've been engaged in for some time to reach out to various websites that have FEMA or census tract data that has weather coding in it. So that's been very helpful to us in terms of quantifying and also mitigating to a certain extent risk. So you can imagine a world going forward where there could be green RMBS that excludes loans that are made in certain zip codes that might be in especially risky climate areas. The other way that we evaluate ESG, though, is more opportunity focused. It's not as risk focused. So as I mentioned, we've had to defend the non-QM model for some time as being socially responsible. And there are many factors that say we're expanding the credit box to legitimate borrowers. We are bringing housing to people that otherwise couldn't get financing through traditional avenues. We are lending to first-time home buyers, to people who are trying to cure their credit. We're lending to self-employed individuals that can't get credit from a banking institution, people who own small businesses and can't demonstrate their income through traditional means. So again, expanding the credit box to make more housing available certainly is a very socially desirable outcome. As far as the conversation really that we're hearing, though, there's a lot around climate change, and so RMBS tends to have a fairly benign footprint with regard to climate change, but we are trying to quantify risk by looking at the different types of climate impact through weather and being able to not only measure it, but also hopefully in the future design products that would exclude those particular risky areas.
Great, thanks. So Neil touched a lot on how you're looking at risk, a little bit of risk and impact. Let's flip to Desiree and get the impact view.
Sure. What we've done, while we have a strategy in place to securitize tradable debt, broadly syndicated loans, positively screened portfolios, we also have a strategy around securitizing illiquid private debt. And one transaction we did last summer, it was a small deal, but very impactful, $175 million financial inclusion securitization. What we did there is we funded 26 financial intermediaries across 17 developing nations. We tagged to 4 of the UN SDGs, poverty alleviation, gender equality, job creation, health and well-being. The proceeds of this deal went on to lend to over 5 million low-income entrepreneurs across in these local markets. And again, these folks are excluded from standard financial services. The other point to note in this deal was that 81% of the proceeds went to female-owned and female-led businesses. In this deal, it's an esoteric asset class, not rated, the loans. This is what we structured is called a blended finance deal. So we utilized catalytic or concessionary finance to make the rest of the structure work. So in this deal, we partnered with the US government. We partnered with OPIC, and they provided the catalytic debt finance, and then we syndicated, JP Morgan was a lead manager on the deal, and we syndicated the mezzanine and equity to institutional investors globally.
Great, thank you, Desiree. Okay, let's switch gears. We know that structured finance is very different in the Americas than it is in Europe and Asia. So, Alexander, you're joining us from London today. Can you give us a bit of the perspective outside of the U.S.?
I mean, generally speaking, the outside U.S., the sector is focused on green, and it seems to be the case in most parts of the world. China is definitely a leader. I know it's probably not a very politically correct statement to make right now, but if you look at the Chinese green bond issuance, probably 5% of overall green bond issuance is ABS. China established quite a few criteria through the Central Bank of China. They have their own green bond endorsed project categories, and a wide range of securitizations follow these green bonds. Around the climate bond initiative, as you know, globally, there is a classification of the bonds. China often falls out of that classification, falls out of it with regards to the use of proceeds. So when you look at the classification, a big portion of the Chinese green bond actually are not recognized at the climate bond initiative. I'm not aware of any securitizations not being recognized, but one can actually think of that. Where does the problem come from? When you look at the different criteria globally, you can see that in some cases the criteria involve both the assets and the proceeds. So you have to have green assets or green proceeds or apply the proceeds green. In other cases, they may focus only on the assets. So that creates a series of problems. In the case of China, again, it doesn't affect the green ABS, affects the other green bonds. The use of proceeds sometimes is for general working capital. And from memory, the climate bond initiatives allows no more than 5% of the proceeds to go for general purposes or working capital. China actually exceeds that in many bonds. In terms of the green bond principles, again, we have the issue with green assets versus application of green proceeds. And if you look at, in the European context, the Association for Financial Markets adopt the definition of green securitization to be focused only on green assets. That raises a number of questions. Can the proceeds go non-green? So you're securitizing green assets, but you're applying the proceeds non-green. That's a question mark. So from that perspective, I think both assets should probably be, both aspects, the assets and the proceeds should be green. The second question is, what is green? That, again, is a whole range of different aspects of discussion. In the European context and in the Chinese context, we already have the categorization, we have the EU taxonomy, you have the Chinese bond, green bond endorsed principles, but that almost always is, again, green. How do we go to the next stage? Under the International Capital Management Association, you have the so-called principles for green bonds, and you have the social bond principle. Theoretically, if you apply the social bond principles to securitization, you should be ending into social securitization. And then to get the next layer of complexity, where if you combine green and social, it becomes sustainable. And then how do we go from there? Earlier it was mentioned the whole business securitizations, but there are a whole range of variations if you got in water, if you get into stale water processing, and so on. So these are the variations. Now we get into the other aspect, which is what is green asset. And I don't know whether you have seen recently Bank of England published a paper raising the question, do green mortgages perform better? Are they a better credit risk? This has been a discussion in Europe which has been going on now for 4 or 5 years. If a green mortgage is a better credit quality, does this mean that a green mortgage pool or a green mortgage securitization should attract a lower regulatory capital? The Bank of England paper seems to conclude that green mortgage PDs are lower, and potentially the LGDs are also lower. That should suggest potentially that the regulatory capital should be lower. So we are moving into all these different directions. I would not say that anything there is a harmonious interpretation. I would not say there is a standardization, but at least there is a lot of thought process going on. And that brings us to the next point, which is how do we deal with S and G, and especially in the G elements. And we are seeing very wide-ranging practices around the world. So I have clients, investors who are looking at whether the manager or the trustee has the right gender balance on their board or in their management, how many of the analysts are from minorities, and things like that. So you can have multiple layers of derivatives when it comes to the securitization market, what you're looking at, what is E, what is ESG, and so on.
Thank you, that's great. Alessandro, would you like to add anything from a global perspective?
Hard to do. Just a general note, because Alex will always beat me on the details. To me, from our perspective, was interesting to see how European clients absolutely lead the charge in terms of demanding that ESG criteria are incorporated in the investment. To that, we need to acknowledge that the European market in particular are really way ahead of the US, and we're being dragged into into that. And so to anyone who has European exposure, expect the demands to ratchet up year over year. But when we look at ultimately the structured finance market, the US is still the leading provider of securitization. Right? By all means, in terms of tradable market, we're there. Even if you exclude the agencies, you're still there. And when I look at the type of markets that we have, the environmental angle is critically important, but we don't really, we don't have yet a lot of solar securitization and green piece. So the governance is absolutely important. Again, securitization has, creates special purpose vehicles. So that adds a whole layer of complexity. So if I look from the lenses of what is the biggest impact that we can do today to fulfill the demand that our investor place on us, I look at the social element of it as where we can make the biggest difference. And I can even tie back to, if you will, the credibility gap that Wall Street has in the eyes of many people, probably well-deserved after the financial crisis. So thinking how the loans that we give, which are primarily going to consumers, impact the life of the people that we give the loan to, and maybe less how the profitability model of the originator is impacted, I think we can have a really, really big impact.
And I'd like to add to that, it's very important to look at all the areas of structured finance, but in the CLO market, I mean, again, I answered a question about a structure that we've done, innovation, and we've, focused on the S, but, as clever as, I think, or our firm thinks we are in coming up with great, impactful structures, the biggest initiative we need to do, I believe, is to get all companies globally reporting out as vigorously on their sustainability profile as they do on their financials. That is the best allocation, the best way we can allocate capital fairly and get companies to transition to greener pastures. That will move the needle the most. I think green bonds, when we're looking at the fixed income market, I think green bonds it's a great start, right? But these are use of proceed issues. So it's not changing the operational behavior. I'm going to bring up an SDG-linked bond that I thought was fantastic. I know there's some controversy around it, but Enel, an Italian energy company, issued a 5-year bond, and they are right now majority dirty energy, if you will. And what they've covenanted is that they will move to clean energy, 55% clean energy in their portfolio during the life of the bond. And if they don't get there, their coupon steps up, they're penalized. And I think what's fantastic here is that it's important that we don't just, benefit, progressive companies in this market, but I think we have to be inclusive and bring all companies, help them, rather than be critical, but help them transition to these greener pastures, and not just on environmental aspects, but also social. I think it's just, as Pia was mentioning about SASB initiatives, is getting these companies to report out on sustainability.
Thank you. And Desiree, that highlights our next question, little rapid fire question about data, working at a data-driven firm myself. And you highlighted just now one of the global trends that we put in our 2020 paper, but it's really ESG in the capital markets. We're seeing explosive growth in ESG-linked loans and issuers coming to us to see if they can use our rating alongside of the credit rating within the loan documentation. Huge increase in corporates coming inbound to us, wanting to provide extra data and concerned about their ratings. So, ESG finally is moving the cost of capital, which is a great thing to see. I've been waiting a decade for this moment. But back to data. The lack of data or what we need to provide, Desiree makes a strong argument that we need companies to disclose more. Pia, do you have an answer to, what data do we need to aid the growth of ESG within structured products?
Sorry. I mean, I personally don't think data is the challenge, especially for structured finance. Thank you, Reg AV2. It's the frameworks on how to use that data that's most important. I can't think of data that, outside of privacy laws that can make a difference in assessing the information. The question is, how do you interpret the data that is ESG? Is lending to subprime borrowers, is that good or bad? The definition is different from everyone. So if I can apply the use of R factor score methodology framework. So for instance, we created a money market fund that utilizes R factor, and so we had to be innovative in applying that to asset-backed commercial paper. So as everyone knows what an ABCP is, you have a liquidity facility part of it, and then you have the underlying collateral. Because of the anonymity requirements of the underlying collateral, you don't know who the underlying obligors are. But for the most part, everyone in the program, issuers, they do provide the underlying sectors and industries. So we have an R factor score for that. And then we obviously know who the liquidity provider, mostly banks. And so you combine that to create an R factor score for that program. And we change it on a monthly basis because the servicer changes the underlying, potentially change the underlying collateral monthly, and so we apply that accordingly. So by being innovative in applying that framework, that's something that you could potentially utilize for structured products. The key is creating those frameworks for the cash flow mechanism, for the counterparty, for the structure, and obviously for the collateral.
Great. Rob or Neil, would you like to add to that question?
Sure. I'll talk a little bit about the data elements. And I mentioned earlier that we gather a lot of data around climate risk to tie that to our residential mortgages. And that data is largely out there, and a lot of it is in the public domain. So it's really a matter of data aggregation. And what we have tried to do at Angel Oak is to tie that to the origination process. So when we are originating loans, obviously we get a lot of information from the application. But we also want to, at the point of application, be able to fly in information that tells us exactly what the climate risk position of that particular credit would be. And that involves some heavy lifting and some expense on our side. There are a lot of data aggregators in the room next door who are desperate to help us out with that effort, and so I'm sure that that's going to be a relatively widespread practice in the near future. What we'd like to do, though, to move beyond just risk, is also to influence our origination process, and we're getting a lot of information now at the origination level as far as our borrowers, but could we inform that more with elements that have to do with potentially the collateral and the extent to which the collateral is environmentally friendly? So any improvements to the house that's already been done or is contemplated under a second, like a HELOC or something like that, that would improve the HVAC or have double-paned windows or install solar or have various roofing materials that are environmentally friendly. And the issue there is really around disclosure of that information. And we know that we can't necessarily set the standards for the entire industry. So we're working with a couple of organizations. We became investors in the CDP, the Climate Disclosure Project, which is an NGO that is trying to drive standardization of disclosures, and mostly at the corporate level, but also just in general for investors. And we're trying to take some of the principles that they promulgate to be able to try to create a standard for the residential mortgage process that would capture this kind of information, ultimately which would be captured then by servicers of these securitizations, so that investors could see this information that would be embedded in their reportable data on a monthly basis going forward. So that's one of the efforts that we're trying to promote, and it's obviously aspirational at this point.
Really briefly, there's a real opportunity here. ABS issuers tend to be medium-sized private companies that don't do a lot of disclosure on ESG-related attributes. And so, like Desiree was saying, and Alessandro was alluding to, there's a real opportunity here to pull out additional information and have an impact in terms of bringing new data out from companies that literally just aren't reporting it. They don't have any other framework where they're required to. And so we've started doing that, and issuers are it's new to them, but they're open, to it. And so I think that's a very important source of data is you get these road shows, your financing is important to them as their bank financing. You have a real opportunity to bring that data out. I also wouldn't underestimate the fact that this kind of gets to the point Pia was making, that there's a whole range of data on the mitigant side in terms of the sort of stuff you see in Intex, with respect to, structural protections and equity underneath your notes. That's what protects ABS and securitizations from corporate risks. it's also what protects those types of structures from various corporate risks. So I think, that's a whole range of information that's not available on corporate debt that I think you need to have some handle on to think about ESG risks and securitizations.
Great. Okay, let's move to a couple rapid fire questions before we wrap up. Number one, the number one ESG trend that the audience should know about today with regard to ESG and structured products. The number one trend I see that's grown over the last 6 months, including in the Americas, is all about climate change. That's all we talk about. Where can I get data points on emissions? Can you give me information on transition risk, physical risk, no matter what kind of fixed income product it is? But learning from my panel and some of our discussions, the E might not even be the most relevant of the ESG when it comes to structured products. So for me, climate change.
Absolutely. So that's the frustration that we face, which is that investors are very conversant in climate change, and that's what's driving the conversation. But it's hard to tie that down to consumer credits. And if you think about what the preponderance of the assets are out there that are CMBS, well, that's CMBS is commercial, but RMBS and a lot of ABS, really it doesn't tie to one corporation, and it's got a very benign environmental footprint. So how do you translate that? It's a challenge. So we're, again, trying to be data-driven to do what we can to report around those risks. I think the leading thing, if this is from the investor's perspective, what we're hearing more than anything, not necessarily about structured finance, but it's really around our investment processes and showing that we have ESG integration across the entire firm. So allocators and investors are asking questions about our organization. So while you're thinking about your investment strategies and the underlying assets, don't forget that investors are very sensitive to the degree to which your company itself embraces environmental responsibility, social responsibility, and good, strong governance.
In international context, there are basically two parts of the structured finance market which are embracing the green aspect, but not yet the S&G, for lack of definitions and disclosure and so on. And these are covered bonds and ABS. One of the main discussions we're facing right now in Europe is not greening, but greenwashing. And that's probably one of the biggest risks we're facing. My concern is that if we do not move to transitional bonds and we try to jump straight into green bonds, we may encourage a lot of greenwashing. We actually have to encourage the transition, and that should be probably one of the main trends in the near term.
So, as mentioned before, I think what's most important, the starting point, again, like what are we confronting? We're confronting climate change and inequality, is to get, companies and trustees to report out. We've got, in Europe, we've got ESMA, we've got, the EU Sustainable Finance Action Plan that's being partially enforced this year, then next year. Here in America, we don't have federal policy, we do have state and local policies. So regulation's one way to move the needle. The other way is here in this room, it's through product. So what I'm very excited about is see the evolution, and I mainly focus on corporate risk and financial and institutional and corporate risk, is the developments in the CLO market. So, we already have, great momentum in do no harm portfolios and ESG-friendly portfolios, negative screening. And I think that we will evolve into positively screened portfolios. But what's so important is I love the initiative by LSTA with the questionnaire, and we have to work with and standardize what are the KPIs we need for companies to report out. And we can drive that in the CLO market since we're like 60% of the leveraged loan market, right? So I would love to see every CLO manager, using this standardized questionnaire. Public companies are, some of them are fairly advanced, and we have to work with the private companies, and I would love to see that development.
Real quick, it's a little bit of a tie for me. Like Rob was saying, I think the intellectual discussion about how is looking at ESG risk profile for a securitization different than looking at the ESG risk profile for a corporate bond or an equity, that conversation needs to continue. And I think that's, coming up with the right framework is, I think, a big part of that conversation, and the confusion we've been talking about, sort of in this panel is part of that. So that conversation needs to continue. And then, like Pia was saying, impact. There are aspects of the securitization market where impact isn't as clear. With the Tesla sort of electrical vehicle lease securitization, that's pretty straightforward. There are lenders to underserved communities, like Opportune for the Hispanic community, where that is a definite good, that they're doing, providing credit to borrowers that wouldn't otherwise have it. It's not really recognized. And so doing some more work, particularly on the social angle, to identify more impact opportunities, I think is important too.
Very briefly, I think we came from a phase that I would call awakening. There's a simple fact that there have been so many ESG panels here, and we're starting to realize the power of engagement. And I think in terms of emerging trend, I think is going to be more standardization, creating a language so that we really understand and we have a common definition of what we do, which is a tricky proposition to do because you get what you measure. So you need to really think long and hard about it. But I hope that we move in that direction so that you have a more ultimately defined approach to it and a more long-term impact to it.
Maybe I'll tell a little bit inside story from my organization. So obviously, ESG is very much more, it's equity focused. And when we talk about fixed income, nobody puts us in the conversation about it. And what was interesting is I had a tutorial with the ESG team in terms of what we do in fixed income, structured finance. Guess what? If you look at a global ag index, 11% of it is structured products, and you're missing that gap in terms of a potential coverage for ESG. And it was surprising to them when we gave them a tutorial that, when you look at in the equity business units, your highest valuation ESG are the greatest companies out there, the Apples and the Googles of the world. But then if you look at fixed income, they're the ones that have the crappiest R-factor score because they have to issue debt and they have to be out in the market. And so this was sort of like a eureka moment for them. And as a result, a lot of it is kind of like, intellectual discussion and sort of like a discovery phase and information gathering. So here in our organization, we're trying to figure out frameworks to apply it for structured finance and other asset classes within fixed income that's not covered by the equity alignment for ESG.
Great. So I started the session saying that I think, structured products are the last frontier for ESG and fixed income. So on that note, what will the title of our panel be in 5 years when we meet again?
So in 5 years, I think the conversation is going to have shifted from the climate space and more into how socially responsible, so how impactful we be. So I really believe that this is really going to be about how to have targeted impact through structured finance, creating products that address specific impact needs, and really through reverse inquiry from investors that want to accomplish specific things in this space.
Well, hopefully we don't have to discuss ESG because everything is ESG by that time.
And, again, I absolutely agree and just hope that, we're not in 5 years, lamenting what we should have done earlier, right? There is a sense of urgency here, right? We have global challenges, and we are uniquely positioned in the capital markets to harness the scale and power to address these challenges, both environmentally and socially. So.
I think there'll be 4 panels instead of 2. And I think that one of them will be a panel with some issuers on one side and some investors on the other side, and the panel will be something like, how do I get better data, sort of from my issuers. So it'll be more commonplace. And then the other one, another panel I think will be real kind of nerdy. I think it'll be something like, because this is the direction the academic research is going, optimal methods for calculating impact from ESG and securitization, something like that.
Well, the title is called ESG Investor Perspective, so I think it will be exactly the same because there will be ESG and also there will be investors. I think the content will be very different, and I think it's going to be amazing to watch how the conversation will have evolved in a few years.
I was boring. I just said evolution of ESG and structured products.
Sounds good. Well, we're out of time, but thank you so much for my wonderful panelists. Thank you.